Thank you for joining us at xm.com for the weekly Outlook video. I'm Christina Marujos. Joining me today is investment analyst Marios Hadjikyriacos, and of course, we'll be having a look at the week ahead. Let's start by having a look at the Eurozone area. We saw Germany earlier this week barely escape a technical recession. However, it appears that the Eurozone economy is losing steam. We have PMIs coming up on Friday. What do you think we'll see in the figures?
Not much, if we're being very honest. The forecasts suggest that most of these indices are going to tick up, but even if those forecasts are met, that would still point to an almost stagnant euro area, which is, it's not exactly what you want to hear. Now, as far as the euro is concerned, I think that the broader outlook is relatively dark. And the argument is, Germany escaped a technical recession in third quarter, according to data released this week. In my view, that's bad news for the entire euro area. The fact that Germany escaped technical recession means that there's now less pressure on German politicians to actually start spending money and do the fiscal stimulus that the euro area desperately needs. So any real recovery in the eurozone is probably even further away than it could have been. The bottom line is we're probably not going to get any real fiscal stimulus anytime soon, which means that there's little prospect for the euro area economy to turn around anytime soon. Therefore, I would say that the broader risks surrounding the euro are tilted to the downside.
I see. Now, let's turn to the United States. We saw the Fed cut rates again in October. However, it did signal that essentially it's closing its easing cycle for the time being, at least. The Fed minutes are to be released this coming week. What do you think we'll see?
They cut rates back at that meeting, but they also signaled the pause. The market is going to look for some detail around that decision. For example, was it unanimous or was there pushback against that? But more importantly, I think the markets will focus on a comment by Chair Powell during that meeting. So he said, during that press conference rather, he said that the bar for the Fed to raise rates again, it would need to see persistent and above target inflation, which was a soft hint that we are willing to let the economy run hot, meaning that even if the inflation crosses above our 2% target, we might not raise rates, we might let that become 3%, for example, in order to re-anchor inflation expectations higher. The bottom line here is, if that much is confirmed by the minute, so if there was widespread support for letting the economy run a little hot, that would argue for a negative reaction in the dollar at that release. However, the broader outlook for the dollar, I think, is positive. The US economy is still in a much better spot than either Europe or Japan. US interest rates are likewise much higher than both Europe and Japan, so there's little real alternative to the dollar right now.
Of course, we're expecting minutes from the RBA as well this week, on Tuesday to be exact. So what are we expecting in the Aussie? Are we expecting any significant moves in the currency?
I wouldn't say so, at least not from the RBA minutes, mainly because they might be viewed as outdated. Back at that meeting, the central bank said, we might also pause our rate cutting cycle. But after that meeting, in the meantime, we've had some weak labor market data, which has gotten the market excited about RBA rate cuts early in the next year. Meaning that even if the minutes reflect the mood of we want to pause, that might not be relevant anymore in a sense. As far as the Aussie is concerned, I would say that it all depends on the trade war. So the mood has been souring lately or in trade. The White House won't admit it, or at least we've had positive comments coming out lately, but increasingly we've seen reports suggest that the two sides have hit a wall, mainly on agricultural purchases and the timeline to roll back the tariffs. Now, the bottom line is, even the phase one deal might not be a sure thing right now. So I think there's a lot of prospect for the markets to be disappointed from here. Therefore, I would say that the outlook for the Aussie is not particularly bright.
And finally, let's move into Canada. It has a very busy calendar this week. The loonie has come under pressure lately, so do you think this week will help the currency recover a little bit?
Maybe, but I wouldn't bet on it. Now, here's my little narrative about Canada. The Bank of Canada at its latest meeting surprised the markets and said, the domestic economy is still fine, but we might cut rates anyway, just as insurance against the trade war. Now, what does that mean? That means that the bar for any Bank of Canada rate cut is pretty low. It might not even be caused by domestic data. So what's the point here? if we were to continue seeing solid data out of Canada, that might not do much to convince the markets that the Bank of Canada will not cut rates. So it might still cut rates even with solid data. Therefore, any upside reaction in the loonie on strong data may be relatively muted, let's say. Whereas, if we get any disappointing domestic data, that could solidify, let's say, or cement the fact that the Bank of Canada is going to cut rates, and it could trigger a much sharper downside reaction. So, yeah, the asymmetric risks surrounding the loonie, I would say.
I see. Marios, thank you for joining me today. And thank you for watching the Weekly Outlook here at xn.com.